Hello, fellow traders. 'Tis I, the Rumpled One. It's Friday, December the 28th, the year 2018. Let's talk trading. One of my old trading buddies, I think I mentioned that he got uh upside down in the Australian yen. And so we were going back and forth in the comments of a couple videos, and I mentioned that possibly he could start hedging the trade, or if his broker doesn't allow hedging, he can do synthetic hedging. So for those of you who don't know, hedging is when you are basically going both ways. In other words, you're long and short the same pair. And so what happens is, let's say you had bought the Australian yen because you thought price was going to go up and it starts going down. So rather than exit the trade, you then sell the and lock in that certain amount of loss. Now, what you can then do is see if you can figure out which direction price is actually going, and then add to that position, either long or short, whichever it's doing at the time, and then basically you can trade your way out of that loss. Now, I used red because this isn't something that you should really be doing, especially if you don't know what you're doing. You can really get yourself into a mess doing this. So it's not suggested, but I just wanted to put that out there, just to maybe help out a fellow trader. Now, on hedging, I had to dust off the old FPI indicator. And if you don't know what that is, you can go out where I post code and you can read all about it. See, basically, the Australian yen is a synthetic pair. It's composed of the Australian US dollar and then the US dollar Japanese yen. So if you multiply the Australian dollar price by the USD yen price, you should get the Australian yen price. But FPI is the fractional product inefficiency. And so you can see here this midpoint one, how it's close, but sometimes it's inefficient. So what the idea is, if you can see this inefficiency, in this case, you would then go short, and in this case, you would go long the Australian yen, because it's going to snap back. It wants to snap back to zero. Let me see if I can show you. So you can see here, actually, in this particular case, it came down, the Australian yen. So you need to buy it so it'll get back to zero. So you can see if that's correct. I haven't used this in a while. So yeah, see right here, the product was off, so it came back to zero. So you can see here how it tends to zero. So basically, if you can't hedge and you're long the Australian yen, then what you want to do is buy the Australian dollar and buy the dollar yen. Because see, when you buy the Australian dollar, you're shorting US dollars when you're and buying Australian dollars. I'm sorry. Yeah, if you buy Australian dollars, you're shorting US dollars. Then if you buy US dollars, you're shorting the yen. Okay, so if you're long Australian yen, I think I might have said that backwards. Let me just do that again, just to make sure I get it right. If you're long Australian yen, then what you want to do is short Australian US dollars. So you'd be short the Australian dollar because you're already long. Then, since you're short the Australian dollar, you then also short the dollar yen. So then it would, because you would cancel out the dollars, and then by shorting dollar yen, you were short dollar, long yen, which would hedge your long Australian dollar, short yen. So you might have to listen to that a couple of times. Like I said, it's been a while since I've done that type of trading. So hopefully that might get my buddy out, because I think he said his worst case he's down 550 pips. I don't know how that happened. I was wondering what his stop loss was, but I guess he just let that one get away. So hopefully that helps. And if I've mixed you up, let me know, and I guess maybe I can redo it. But I guess the thing is, to my buddy, he blew his money in risk management. I believe he said he had a stop loss on, maybe it was a mental stop, and then he thought he could trade his way out, and one thing led to another. So, boys and girls, don't do that, right? Okay, Euro Yen, 79 pips off that bottom of the month. You can see here, hey, look at this. All the gaps have filled. It's Friday. So, traders, once again, you see this happen week after week after week. I mean, we almost always have gaps filling. I mean, we had one week, I think we had 4 didn't fill. I think that was the worst out of the year. But just because it didn't fill didn't mean you didn't have an opportunity to take profit on the trade. And to me, that's the most important thing of any method or system. Whether or not it gave you an opportunity to take profit. Because that's all you need is an opportunity. I don't care if it's 1 pip. If it gave you an opportunity, you had the chance to take profit. Because a lot of people talk about, oh, it was a false breakout. It only broke out 1 or 2 pips. False breakout. No, it broke out. The breakout was 1 or 2 pips. And the thing is, I really think is that when people are trading, a penny a pip or a dime a pip, yeah, I mean, it doesn't even look, there's nothing. But I mean, if you're trading $100 a pip is $100. So, as I call it, that's some folded money, and you're not going to let that slip through your fingers. Okay, looking at the daily chart, you can see here we entered the upper wick zone, came out of it. We're now into the lower wick zone on the daily. Once again, the range on the euro yen's anemic. Dollar yen's beating it. We've only got 5 pairs over 100 in range. Buy zone pivot was below the open right here. And so the bias was short right here. You can see it came, it closed in, didn't get out. That should have been a scratch trade. If you didn't scratch, you took a stop. Then if you bought here, and then you didn't scratch, you stayed in, you took a stop. Now you see, this is where people talk about, oh, you get whipsawed, you get whipsawed. Well, that may be true. Once again here, if you took this trade long, right there it's telling you it's coming back, just take your 1 pip. And in this case, though, you took your short and it hit the pivot. And that was good for about, 10 pips. Rat zone, as you can see here, Larry live trade, we've got the last chance at 46 right there. Here's a nice example. Remember I told you about turn trades yesterday? Red, green, right there. There was a nice little turn off that bottom. And the turn trade at the top, you can see here, green, red, and there's a little, here once again, green, red. So that's pretty much what you want to look for on those turn trades. And it's just so simple. Now, it really works. Say if you get a turn trade on a weekly or daily, then you know you've got that bias, you know when just to look for those longs. Once again, we took out the pivot, and you can see here we took out this pivot from earlier in the week. So we still just have those two missed pivots. Now, see, once again, see, it missed that pivot back here by 2 pips and missed this pivot by 7. So it doesn't mean you didn't have an opportunity to make profit. So once again, all you have to do is take profit when it presents itself. Might not be as much as you wanted, but let me just take a look here. See, we missed this by 2 pips on 10-2. 10-2, high minus open was 14.2. So I don't know if that was if the pivot was below or above. It probably was above. So once again, we just had those 2 missed pivots. Yeah, so you can see here, it just slightly missed it. There was profit to be made. Right here, once again, slightly missed it. Profit to be made. Okay, Larry live trade, 2 ball at the bottom. Short trigger would be 40 on the next H1 bar, unless something happens between now and the next bar. Price at the line, once again, you can see here, price was green at the line, took that long, came back right about here's where you should have taken profit when it started dropping against you. Wick zone, in and out. So right here, into the wick zone and out, into the wick zone and out. Right here, 26.39 is the next buy. Larry live trade. Highest open trade, Larry live right now at 32. And on the inventory retracements, we've got a long trigger at 38, 26.38. And there was a short at the 126.28. Only good. Oh, we just put in a new trigger. So you saw that happening live. So that's an inventory retracement bar. That's the short trigger now, 26.25. So this indicator that I wrote on the inventory reduction, it only puts the line on the most recent, and it puts dots on all the previous. Otherwise, if I had put lines on all of them, it would just fill up the screen. I don't even think I have that option. Does it plot all lines, background, truth, indicator tag? Yeah, no, I didn't even put that feature in. It would just fill up. You can see all the dots. So it would just make the chart a mess. And we don't need any charts on drugs, right? Simple charts like this. Wow, look at all that buying. Just horizontal lines, candle color at the line. And you can see here, price is just hovering. Just pretty much about a 1 pip range there. Nothing to write home about. Once again, Einstein line trade. Looks like a Larry live trade here. Okay, inside bar. Oh, let's see. We had a couple yesterday. Right here, we've got a breakout on the dollar yen, good for 10 pips. So you break out here on there, good for 42 pips. Okay, we had a little breakout to the bottom, but it came back. Ditto here. Oh, here's the Australian